Hello and welcome. Today we'll look at the point and figure chart. We'll cover its features, as well as discuss how they're useful to day trading, scalping and swing trading. And we'll also see how to spot supply and demand zones using this type of analysis. So, if you could, like, subscribe to the channel, and stick around for the full video. Here we have a chart showing data from the past 24 hours. On the right, we have a classic candlestick chart, and on the left, a point and figure chart. Both charts are showing the same thing. The display is different. The candlestick chart displays the price as the linear function of time, shows how the market behaved during certain periods of time, in this example, one trading day. But the problem is, sometimes you don't need to know how the price changed in time. All you need to know is what the prevailing force on the market is at the moment, demand or supply. This is where the point and figure charts come handy. They show the price changes graphically, independently on the time during which the changes have occurred. Here we have 5 days of price action. Point and figure charts provide a simple yet a disciplined method of identifying current or emerging trends in prices. They rely only on price movements and not on time intervals during the creation of the chart. In this way, these charts are similar to Renkos. So point and figure charting reduces the importance of time on a chart and instead focuses on price movements. These charts are also excellent at filtering the non-moving days. Point and figure charts map out the relationship between supply, created by sellers, and demand, created by buyers, at different price levels. When demand exceeds supply, more buyers than sellers, prices rise, and this is reflected by a column of excess on the chart. Conversely, when supply exceeds demand, more sellers than buyers, prices fall, and this is reflected by a column of O's on the chart. The objective of a point and figure chart is to identify the points at which established supply and demand relationships change. These are known as breakouts. These changes will very probably lead to a future significant move in price. The green X's are the price increases, and the red O's are the price decreases. A column of X's represents an uptrend, while a column of O's represents a downtrend. In each particular column, there can only be X's or O's. When one trend ends, a new column starts. So, X columns represent rising prices, while columns consisting of O's denote falling prices. There are two inputs to a point and figure chart: the box size and the reversal amount. The X's and O's that make up each column occupy a space called the box size. The box size is the size of the movement required to add an X or an O. The box size value is determined by each trader. When price moves enough in the same direction as the current column, a new X or O is added to that column. When price closes far enough away in the opposite direction, a new column begins with either an X or an O, the opposite of the previous column. The amount that price must move is determined by the reversal distance. This value is created by multiplying the box size by another value defined by the trader, the reversal amount. The reversal amount is the number of boxes price must move in order for a new ladder to be drawn or a new column to be created. Therefore, if the box size is set to $1, and the reversal amount is set to 3, then price must move $3 in order for a new ladder to be added on the chart. There are two methods for calculating reversal distance. First is the average true range. This method uses the values generated by the average true range indicator. The ATR is used to filter out the normal noise or the volatility of a financial instrument. It calculates what the ATR value would be in a regular candlestick chart and then makes this value the reversal distance. The second method is the box size. New boxes are only created when price movement is larger than the predetermined reversal amount. The upside to this method is that it's very straightforward, and it's easy to anticipate when and where new boxes will form. The downside is that selecting the correct box size for a specific instrument will take some backtest. I wish I had the perfect box size that will work on any market, but this isn't the case. We all have to backtest and find the right size for our trading style. Here are some tips regarding how to set the correct size of the box if you're not using the ATR method. So the box size is based on the scale you wish to use for a particular market, and it represents the value given to each box, X or O on the chart. It's the minimum price change needed to continue the trend, meaning to add an X to the top of the column of X's, or the minimum price decrease needed to add an O to the bottom of the column of O's. The reason that this is an issue is because a reversal of $3 for a $10 stock is more dramatic on a different scale than a $3 reversal on a $100 stock. Furthermore, since point and figure charts are used to filter out noise in the market, you will want to be sure that you are filtering just enough to eliminate momentary price reversals, yet at the same time, you can identify when a significant reversal is taking place. As you use point and figure charts, you may find that different box sizes work better for your trading style or for a particular market. I don't use the ATR method because I prefer to have full control, so I set the box size manually depending on the market I'm trading. For Forex, box sizes of 10 or 20 pips are a good start to backtest. For stocks valued between $20 and $100, I use a $1 box. For stocks above $100, I use a $2 box. If you trade penny stocks, use 50 cents or 25 cents boxes. These are just a good starting point. You can adjust the box size depending on the market you're trading and your trading style. Now, another aspect to consider. Old school traders typically prefer the high and low prices for the period, while others may focus strictly on a single price, such as the close one. Depending on the prices you use, you may get different results. There are two rules regarding the letters and the columns. Each column has to be either X's or O's. There can never be two different letters in the same column. X columns and O columns will always alternate. You will never see two X columns side by side and vice versa. If there are 3 or more X's in the column, demand is in charge and has overcome supply. The reverse is also true. When the chart produces 3 O's in a column, this indicates supply has overcome demand. In this way, point and figure charts show the establishment of trends and trend reversals in a clear and organized manner. Their usefulness lies in their ability to filter out market noise, the short-term price fluctuations that occur during longer, more established trends. They don't take trading volume into account, and they are only affected by the price movements. How to use point and figure charts to find supply and demand zones. Now that we have gone through the process of creating a point and figure chart, the next step is to understand how to use this chart as part of your decision-making process. Point and figure charts are great for visualizing support and resistance levels, trend lines, and breakouts. First, let's talk about support and resistance using point and figure charts. A support level is a level at which traders believe prices will start to move higher after hitting the level mark. Have a look at these several O's in the example. An horizontal row of O's is what you are looking for when zeroing in on a trend reversal and an uptrend to begin. An horizontal row of X's marks the resistance levels you need to be looking for in the point and figure charts. So support levels are identified as an horizontal row of O's, which represents a level at which demand overcomes supply, meaning where buyers feel confident to step in. Resistance levels are identified as horizontal rows of X's, which represents a level at which supply overcomes demand, meaning where sellers feel confident to step in. Have a look at this chart. At this level, there is more supply than demand, as sellers step in and prices retreat. And at this level, there is more demand than supply, as buyers step in and prices rise. A simple analysis of long-term point and figure charts will often reveal levels at which prices consistently find support or resistance. These are key areas from which we will be actively watching for new point-and-figure bull or bear trends to emerge. At support, we will look for further confirmation such as selling climaxes, particularly if on high volume, but this is a more advanced topic for another video. Conversely, pay attention when price is reaching areas where they find major resistance. These are levels at which the next price moves are likely to be downward. Trend lines are very important in point-and-figure analysis. With point-and-figure charts, drawing trend lines is easier than with other charts because the subjectivity is eliminated. According to the point-and-figure theory, when the time doesn't distort the price action anymore, the rising and falling angle of a market is close to 45 degrees. There are 4 different types of trend lines you can use with point-and-figure charts: bullish support, bullish resistance, bearish support, and bearish resistance. The bullish support line is used to identify those markets that are in an uptrend and to alert you to potential reversals in an uptrend. Markets above their bullish support line should be assumed to be in a long-term uptrend. The trend line doesn't connect points and can therefore be drawn immediately when an uptrend begins. It can be drawn from the lowest point made after the completion of a bear trend or a significant down move, and it's drawn at a 45-degree angle. However, you can also draw trend lines the classic way, at any angle you want, and backtest future price action. As a rule of thumb, you should never buy prices that are trading below their bullish support lines. A break of a bullish uptrend line that has been in place for a considerable amount of time is considered to be a bearish event. Markets below their bearish resistance line should be considered to be in long-term downtrends. The trend line is drawn from the highest point after the completion of a significant uptrend and is extended downwards at an angle of 45 degrees, as far right as possible. Again, you can experiment with other angles. Short positions should be considered while the price is below the line, and any buy signals found below this line should be disregarded. A break of the bearish resistance line is considered to be a bullish event. This video was intended to familiarize you with point-and-figure charts and the basic supply and demand theory. It's important that you fully understand how these charts are forming, the box sizes, and the reversals. Without a sound knowledge of this information, it will be difficult to understand the following videos and the more in-depth features of the point-and-figure. I'm currently backtesting these charts, mainly for support and resistance, and I must say, I'm having good results. I can see the support and resistance levels much clearer on these charts. I'm planning another video with the main point-and-figure chart patterns and several breakout strategies you could apply for swing trading and day trading. But I don't know if this topic is interesting to you. I know these charts are considered old and outdated. So, if you want a follow-up video on the point-and-figure trading, leave a like and subscribe. This way, we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.